What happens if your mortgage rate lock expires before closing? Imagine you're all set to buy your dream home, but suddenly the clock runs out on your mortgage rate lock. What does that mean for you? Well, when you lock in a mortgage interest rate, the lender guarantees that rate for a specific period, usually between 30 and 90 days. This helps you plan your budget and protects you from rising rates. But if your closing gets delayed beyond that period, things can get a little tricky. If your rate lock expires before closing, one common option is to pay a fee to extend it. These fees can range from about 0.1% to 1% of your loan amount. For a $400,000 loan, that could mean paying between $500 and $4,000 extra. Sometimes, lenders will waive this fee if the extension is just a few days. Extending your lock keeps your original interest rate, which can save you money if rates go up. If you decide not to extend or cannot afford the fee, your lender might offer you a new rate based on current market conditions. This new rate could be higher or lower than your original lock. If interest rates have increased since you locked in, you might face higher monthly payments and pay more over the life of your loan. But if rates have dropped, you could get a better deal. Keep in mind, this depends on your lender's policies and the timing of your request. Another option some lenders offer is to let your rate float with the market. This means your rate will be whatever the current market rate is at the time of closing. There's usually no fee for this, but it carries the risk of rates rising before you close. If rates fall, you might benefit, but if they go up, your costs could increase. Changing your rate after the lock expires can also mean your loan needs to go back through underwriting and processing. This can cause delays and possibly additional costs. It's important to stay in close contact with your lender if delays happen. To avoid these issues, plan your closing date carefully within your lock period. If delays are likely, talk to your lender early to negotiate an extension. Understanding current market trends is also helpful. In a rising rate environment, letting your lock expire can mean paying more. If rates are falling, you might consider letting it go and locking in a new, lower rate later. Sellers should also be aware that delays on their side can cause buyers' rate locks to expire, which might complicate negotiations or affect the buyer's financing. In the end, if your mortgage rate lock expires before closing, you could pay to extend it, accept a new rate, or let your rate float. Each choice has different costs and risks. Staying proactive and communicating with your lender can help you manage these situations smoothly and keep your home buying process on track.